Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. It's another holiday-shortened trading week because of the New Year's holiday, so we thought it was a good time to get more 2014 predictions from more of our top Zacks strategists. Joining us this time around is equity strategist Tracy Reinick, senior equity strategist Kevin Cook, and ETF strategist Eric Dutram. And so, Tracy, let's just note this one important note about the stock market before we get into predictions. Although this kind of dovetails with a prediction anyway. This Santa Claus rally, there's no denying it this year.
No.
And this is the biggest one that's taken place in the last 3 years?
Yeah, this Santa Claus rally has been phenomenal. But, I mean, it's the biggest rally in the Dow in, years. I mean, it's just been rallying like crazy since the Fed announcement, basically. And, the biggest one we've seen in the last, since the recession, Santa Claus rally was in 2008 when it was up 6%. But we're up at least almost 4% on the Dow, I think, right now. And that's, a tremendous kind of momentum into the end of the year here.
So no one's a bear, virtually.
Virtually nobody, no. I mean, even when you look at all the polls they've done of the bears versus the bulls, it's at among the lowest since 1999, I think.
But Kevin Cook, you're seeing about a 10% market correction here for 2014.
I expect one, yeah. We'll finally get one.
Early in the year?
I don't think so. I mean, I would say first quarter, we're fine. We could get some catalysts that start to develop in the second quarter. But you know what? The odds favor the bull running. So what I'm saying is if we do get a correction, you want to be buying it. And it would take, if we got a series of bad economic data, say another, some kind of blow to GDP or the manufacturing or housing, any data like that, I think the market will sort of overreact one way because it's priced in a lot of great news, right? It's run ahead. The market's run ahead of the economy. So if we take some hits there and to earnings estimates, then you'll see this rush for the exits, but I think it'll be a buyable dip and that the market will still close above 1,900 in 2014.
Yeah, you're talking 1950 on the S&P
At
by
least,
the end of the year. Eric, though, you're taking a little bit of a cautious stance because of interest rates. You feel that interest rates are going to hit 3.5% sometime in the new year. What's that going to do to the rally?
Yeah, I mean, if you looked at the beginning of 2013, and the rates were, I think, about 1.6% for the 10-year, and you had said to someone, hey, it's going to be pretty much double that at the end of the year, no one would have believed you. And I think as unemployment continues to fall and gets closer to that 6.5% mark, a lot of traders are going to be very concerned, and this is going to kind of push up rates even further. And I think we're going to see a slow move over the year up to this 3.5 level. And I don't think anything's going to happen the first quarter, kind of going along with what Kevin was saying. But I do think, late first quarter, early second quarter might be a little bit of weakness, though I still look for about 8 to 10% gain for the S&P 500 on the year. I don't think we're going to get as great of a year as we saw in 2013, and 2012 was pretty much flat. So I think we're going to go back to the norm for 2014.
But look at your logic on rates. If nobody expected rates to double, and look what the stock market did anyway, I mean, that's almost arguing for the stock market is in its own, it's in its own momentum for a lot of reasons, and it can handle 3% rates right now. I think it can handle 3.5.
Well, I think you got to wonder what happens with housing. We've already started to see that slow down, and is housing still going to be strong if rates move up to 3.5, 4%, and we get a 5-6% mortgage rate? I think that's really the key to this situation. If that doesn't happen, I think definitely you're right, but if housing falls apart here, that's going to be a real drag on the on stocks, I think.
Yeah, that's the big question, if it falls apart. But getting back to 5 or 6% mortgage rates, I don't think is going to make it fall apart.
Well, Tracy seems to think housing's going to falter in the new year.
Well, I do, because while those rates are still low historically, everybody keeps saying that, 5% mortgage rate, that's still incredibly low. Prices have also gone up. I mean, in many parts of the country, especially the major metropolitan areas, we're back to 2006 or sometimes all-time high. So, we don't have rising incomes. We got rising prices, now rising rates. I don't remember the last time we had rising prices and rising mortgage rates. That's going to, I believe, I agree with Eric, bring a drag on overall housing into 2014. But right now, I don't know. So far, buyers seem willing to put up with both of those things. But if we see the rates go back up over 5%, mortgage rates in the 30-year, I do think that that's going to slow down housing. And it's a big job creator. So we'll have to see.
You also feel China will finally have a credit crisis, debt crisis, whatever. Kevin Cook says no, they won't.
You can't really predict these things. And for years I've been saying, China's had issues. I mean, they've been stimulating their economy as long as we have been. They've been building the roads to nowhere 2 or 3 times. They have the ghost cities. All these things are well known, and still they, still trudge on.
Not to mention the fact that you don't believe anything that comes out of China.
Right. I don't believe a lot of the data anyway.
It starts with that.
Right, exactly. But we're starting to see a little more cracks in the facade here going into 2014. We just had the central bank had to pump in at least over $50 billion just to make sure that the banks were lending to each other. The 12 largest banks got these huge infusions of cash. Mm-hmm. That's never a good sign. I don't really want to hear about my central bank having to put cash into the banking system.
Okay.
So for those reasons, I feel like 2014 is the year they won't be able to keep it together.
All right, Kevin, you don't see it that way.
No, I think that they can. You got to go with the trend. The trend is China persists, right?
Well,
and I
so
think
far.
their central bank has learned lessons from our central bank, and they'll figure out a way to get through this. It doesn't have to implode. They can find a way to work through it.
All right, Eric, stock buybacks are going to peak in the new year.
Sorry, just to go back to that real quick.
You still want to do the China thing?
Well,
okay.
sort of. I think China's going to skirt by a lot of these issues in 2014 just because a lot of the focus on emerging markets is going to be on these political issues like we've been seeing Thailand, Turkey. India has a big election coming up. So I think no one's really going to be talking about China because they're going to be worried about what's happening in some of these smaller markets that are going to have a lot of political issues. But for buybacks, I think as the economy slowly, hopefully improves, and we got this whole rate issue we got to worry about. But I think a lot of companies are going to say, hey, stocks are at record highs. Maybe we should really try and hopefully at least invest in our operations once again. And I think buybacks are, still going to be high, but possibly peak here in 2013 and hopefully get a little lower going into 2014.
Oh, okay. All right. Tracy, advice to investors, you say don't chase the hot stocks.
Right. Everybody's following, the Twitters of the world now, and a lot of those have been soaring, especially the technology. But there's a whole host of other stocks, including value stocks that are out there that have great fundamentals, good outlook going into 2014. Look at some of those because they've been going up, just as much as the others, but with the better fundamentals.
Kevin, you had some good advice for investors. Not only buy the pullbacks, but have a plan for taking profits.
Absolutely. You want to. I think that one way to look at the market and your portfolios is to have buckets of risk. Say, hey, I'm going to take 20 or 30% and be aggressive with it, and I'm going to take 20 or 30% and focus on blue chips that pay dividends. Maybe another 20, 30%. I'm looking at corporate bonds or other types of income. But this market is going to go higher. The forces pushing it higher. Include the economy, include rising earnings estimates, and fund managers trying to outperform. You guys talked about the so-called Santa Claus rally. These guys have to buy it at year end here just to make their books look like they participated in a rally.
That's a good point.
Especially if they didn't beat the market. So I think the secular bear market's over. Regardless of that, this bull trend is so strong, and I'm a big believer in mean reversion, which means you go up and you come back down. But you mean revert after you hit an extreme, and we have not hit an extreme yet. This is like the 90s. This year has been like a year from the 90s, and believe it or not, you could see another double-digit year on top of the 25-30% year we just had.
Eric, some actionable advice in the ETF area for investors?
I think I'm going to be looking at the gold mining space, actually. If you're maybe going that high-risk bucket that Kevin Cook's talking about. Because some of the gold mining ETFs are down over 55% on the year, and that is an enormous loss. And while gold, I think, is going to be a little touchy in the new year, might be a nice way for investors who have a very high risk tolerance to take a look at this space.
Kevin thinks gold's coming down, right?
Oh, I think gold is still going to make new lows in the year, and I think it presents a problem for the miners. I mean, you can be selective with miners. And mining ETFs, your risk is lowered because you've got this basket,
Yeah.
right? It's not going to zero unless you buy Nugget. But I think that this creates a sort of a new perfect storm for the miners because they're cutting dividends. If they have to make a decision to cut production, that's sort of a big, 6 to 12 month outlook, and it means we think things are going to get worse. We're pulling in the reins. We're trying to preserve cash, and I think that kind of snowballs for them. So things could get much worse here for the miners and gold in the first half of 2014.
Definitely risky, but it's just been beaten down so much, and if you're looking for a nice contrarian play, this could be one.
Yeah.
All right, we're going to leave it there for time. And as we sit here on the last roundtable session for 2013, we want to take this opportunity to wish you a very happy new year and profitable new year as well. And we will see you with our first roundtable edition early 2014. Now, we have some top stock picks from these folks that we don't want you to miss. Those are in our next segment, so click on over.